Hi guys, and welcome back to the Mindful Investing channel. Today I want to discuss with you the most important principle to understand as an investor and C-suite member: capital allocation. By the end of this video, you will have a solid understanding of how to effectively allocate capital to optimize shareholder returns, as well as to spot incompetent management, therefore avoiding investment mistakes. So let's get started. Let's start off with a quick definition of capital allocation. Put simply, capital allocation is the process of evaluating different investment opportunities to achieve the highest return on invested capital, therefore also the highest return for shareholders. For public companies, there are 4 ways to allocate capital. First, investing in the business. Second, M&A. Third, buybacks. And fourth, dividends. Each of these options has its own advantages and disadvantages, and the decision on how to allocate capital needs to be evaluated on an ongoing basis. So let's go to these options one by one and see under which circumstances they should be utilized. One way to allocate capital, which is almost always mentioned by companies, sometimes rightly so, sometimes not, is investing into the business. As mentioned before, capital allocation is the process of evaluating investment opportunities to achieve the highest return on invested capital. But how does this apply to reinvesting into the business? Let's assume Old Joe's Ice Cream currently operates 10 ice cream shops. The cost of setting up those 10 ice cream shops was $1 million, and they generate $500,000 each year in earnings. In this simplified example, the return on invested capital of the ice cream shops is therefore 50%. Basically, the earnings of $500,000 a year divided by the required investment of $1 million. Let's assume Old Joe's Ice Cream could open up further shops at the same unit economics as the already existing ones. Opening another shop would require an investment of $100,000 and generate earnings of $50,000 a year. Old Joe's Ice Cream is therefore a great business with the ability to grow earnings by 50% a year by simply reinvesting the cash flow generated by its ice cream shops into new ice cream shops. Given such a high return on invested capital, the best thing would likely be to just reinvest all cash generated into the opening of new shops. Unfortunately, in real life, the return on capital usually decreases the larger a business grows. This is due for 2 reasons. First, high returns on invested capital generally attract competition. In our example, let's say Donny's Delightful Ice Cream opens up in the same street as Old Joe's, diminishing profitability and return on invested capital. Second, high return on invested capital businesses quickly saturate the market. If Old Joe's, for example, grows store count by 50% a year, it will soon be competing with itself, given that there are only so many people wanting ice cream, therefore reducing overall per unit profitability and return on invested capital. Another issue when assessing return on invested capital is correctly calculating invested capital, which could be another video on its own. Another way to achieve high returns on invested capital is through buying other companies cheaply. Prominent cases that have achieved superior shareholder returns through the execution of an efficient M&A strategy are Constellation Software, Livco, Judge Scientific, and many others. Once again, let's have a look at the example of Old Joe's Ice Cream. Let's assume Old Joe's competitor, Donny's Delightful Ice Cream, wants to exit the ice cream business and sells its shop. Like the shops of Old Joe's, Donny's shop generates annual earnings of $50,000. Due to no other potential buyers, Old Joe's can buy the shop for 3 times earnings, or $150,000. Old Joe's would therefore be able to achieve a 33% return on invested capital when buying Donny's shop, which is a great return. Similar to the capital allocation option of reinvesting into the business, the return that can be achieved through M&A generally decreases the larger the business becomes, primarily due to increased competition and higher efficiency in the sale process. Another way to allocate capital are share buybacks. While many companies utilize stock buybacks indifferent of their share price, buybacks are only an intelligent capital allocation tool when used strategically. Let's see why. Let's assume Old Joe's will grow earnings by 10% each year going forward, and its trading multiple stays unchanged at 10 times earnings. Based on those assumptions, an investment in shares of Old Joe's Ice Cream would return 10% annually. Said return would also be the return on investment Old Joe's would achieve by repurchasing shares. While a return of 10% is certainly not bad, it's definitely not a return that would warrant an investment from me. Nevertheless, buybacks can still lead to exceptional shareholder returns when used strategically. To see why, let's assume that old Joe's trading multiple is not fixed at 10 times earnings anymore. Let's further assume that while old Joe's generally trades at 10 times earnings, it's currently trading at 5 times earnings due to some kind of general market crash. If we assume that old Joe's will trade at 10 times earnings again in 2 years and continues to grow earnings at 10% annually, an investment in old Joe's would return around 51% annually over those 2 years. Buybacks would therefore also be a highly attractive tool. The last tool in the toolbox of capital allocation are dividends. Whilst good capital allocation in very limited cases, dividends generally are the worst way to allocate capital. The reason being that dividends are highly tax inefficient and imply that the company has not identified any capital allocation opportunities that can generate higher return than its shareholders could achieve by investing into other assets. Still, especially for large companies with high valuations and no organic or M&A growth potential, paying dividends could still be the best way to allocate capital. One example would be the large tobacco companies like Altria. Let's quickly recap. There are 4 ways to allocate capital: investing into the business, M&A, buybacks, and dividends. To achieve high returns for shareholders, different capital allocation options need to be tracked and evaluated constantly. Bad capital allocation, like paying dividends when the stock is vastly undervalued or doing buybacks regardless of the current valuation, usually are a sign of bad management and should be seen as a red flag when investing. That's about it for today's high-level video on capital allocation. Please leave a like if you enjoyed the video and feel free to ask any questions in the comments. See you next time.